I think that investors should focus more about current cash returns because
Mhm.
if there's no upside or it never appreciates, at least you know you're getting your 8 or 9 or 10% a year for whatever 7 or 10 years and getting your money back, hopefully, rather than bet on a deal that might not have any cash flow and you're betting it all, on,
On
for lack of a better
appreciation, maybe. Yeah.
appreciation.
Are you looking to achieve massive success in your life without dealing with costly investment nightmares? If yes, then this is the podcast for you. Here, we provide engineers and busy professionals all the secrets and strategies to create multiple streams of income, build generational wealth, and live a meaningful life by design. Here's your host, Ted Patel.
Hey everyone, this is Ted. This is your host Ted Patel, and welcome to this week's edition of Decoding Cashflow Podcast. I'm here with Irwin, who is the head of acquisitions at Peykar Capital, a fourth generational real estate family office. And here he focuses on investments and asset management. In the past, he has been a head of real estate of several family offices and was involved with making investment decisions for them. He currently advises investors on existing and potential investments and provide asset management services. So, Irwin, welcome to Decoding Cashflow. It's a pleasure having you on the show.
No, thank you for having me. This will be fun. I'm always happy to share with other investors and potential investors. 35 years of history in the business. The good, the bad, the ugly, and when to run away.
Yeah,
So thank you for having me.
All right. Yeah, we'll go through all of those details that you spoke about.
Sure.
But before we dive deep into your niche, right, if you can give our listeners a little bit background about yourself, like, how did you get started in the real estate and what's your main focus as of now?
Sure. I started my real estate career as a practicing CPA with an accounting firm that had a lot of real estate clients. And it was kind of interesting because when you're an accountant, anyone in finance, you really just deal with a bunch of numbers. You really don't touch the bricks. You don't know if the numbers make sense other than by comparing one year to another or
Mhm.
comparing one building to another or maybe some industry standards. So when I got tired that I was tired of just looking at numbers, I went to work for a large owner operator who gave me the opportunity to actually manage buildings. And so I started out in multifamily, worked for the LaFrac family, managing, 4 buildings in Queens. I had 1,000 units. I had 20-man union crew. I had to do everything from figure out how to get things repaired to go to landlord tenant court and collect rent to deal with federal and state agencies with some of the tenants, if they had Section 8 or senior housing or whatever it was.
Yeah.
And through my career, I've either worked for owners or platforms or as a lender, working for savings banks or mortgage banking, originating multifamily for Freddie Mac, Fannie Mae, HUD, as well as CMBS loans and life insurance company loans on office buildings, shopping centers, and sometimes industrial buildings. So I've got to see how everybody looks at it, whether you're the lender, whether you're the owner, whether you're the underwriter, what people make credit decisions on. And it's really given me a good background for how I look at an investment and what I think is the most important to me for the long term.
So you have been at the both side of the coin,
Correct.
right?
Both sides.
That's a really good experience, right? You know exactly what the lenders are looking for, and you can prepare while you're doing the acquisition of any properties. You can keep that in mind and underwrite the deal or prepare the documents accordingly.
Yes, and sometimes it's not just you preparing the documents; it's how you prepare the documents.
Yeah,
As having to know who is looking at them and how
yeah,
they should be presented. And sometimes it's just easier to give them the backup or answer any questions where they think they're going to have questions in advance.
that's true.
I've learned that lenders greatly appreciate transparency
Mhm.
rather than them have to dig sometimes. And if there's a problem and part of your acquisition that you're acquiring something is because you have a solution for the problem, put it all down on paper, explain it in
Yeah,
the business plan, and make them feel comfortable with why it's going to be successful.
that's true. Yeah. So, as I see, right, before we start recording the podcast, we discussed like you're working at the Peykar Capital, which is a family office, right? So, does this family office focus just on real estate, or there are other investment also under
Sure.
consideration?
The business was founded by four brothers many years ago. The parent company, which is Nurison, we manufacture and import rugs from Asia and other parts of the country, and we sell to decorators as well as Amazon, Target, Home Goods, all the full price retailers. Then there are lines that go to the discount retailers.
Mhm.
And for over 20 years, they've been investing a lot of their profits into commercial real estate, everything from apartments, retail, office, hotel, and industrial. And when I was brought on just about 5 years ago, in the middle of COVID, everyone was, they needed someone to really focus, dedicated on the real estate. Oh, the lights just went out here. I love these motion sensors. Always trying to save money. And so we've done a lot of new acquisitions. We've built some new industrial buildings. And over the years, people that were primarily in other asset classes kept saying, "How come you don't invite us into your deals? We like industrial. We just don't know anyone that does it." So, the last couple of years, we've invited a large group of other investors into our deals. And every year we have a few more that join us. We've taken people in that have 1031s as a tick, which is good for them. We have a lot of doctors and attorneys and other professionals that are really looking for long-term cash flow, which is what we look for. If I can't go in at, let's say an 8 cap and finance at a 6 and be able to produce current cash flow in the first year, the deal's not attractive. I'm not betting on something that may never happen. And I guess a lot of the investors appreciate that. For them, it's all about a sustainable cash flow. And we have, quite a few doctors and dentists that look at this as, when you can't practice anymore, you want to have that income coming in. So it's a good way to shelter it with the depreciation and put the money to work for you.
Yeah. So what I hear from you is like this is not like a closed family office investment firm. Like only the money in the family office gets invested. You also invite the outside investors.
No, that's correct.
Partner with on your deal.
There are some investments that we've done that were construction deals that were family only. But because we'd like to be able to expand on what we do, now we've invited other people in. We still control the deal. We're very hands-on asset management. We make all the leasing decisions in-house. We really focus on discount to replacement cost, as well as sustainability of occupancy. Am I always going to be keeping it full? And a lot of that is based on the basis. If you're buying a building at the lowest cost per square foot, you can rent it at the lowest cost per square foot. And one of the things I look for in an investment is, how sticky is the tenant? How many people do you employ? Where are your suppliers? Where are your customers? That tells me that you really need to be in that location. And that's really what I've learned the last 5 or 6 years. It's more important when you go visit the property to ask the tenant, tell me about your average tenure of your employees. Tell me about their commute. How far do they live? Because that tells me a lot, about how sticky they are. It's not always a question of, what are the buildings renting for or selling for on a per square foot basis, because that can really be misleading. And I look at an acquisition, 50% of the return comes from current cash flow, 50% comes from long-term appreciation. And like we have deals that are currently distributing 10%. And my investors, I'm like, well, if we get a crazy offer, what do you want to do? He goes, well, I think we should talk about a refinance and maybe de-risk the property and hold it with that kind of cash flow before we go and sell it, because everyone doesn't have any place to put the money. And we're happy to hold the deal. We've held deals. I think we have some assets we've held almost 30 years as a family. Refinance them and cash flow them. So that's one of the advantages of investing with a family office who has a long-term cash flow perspective than investing with someone who is, I guess, for lack of a better word, a syndicator who's interested on IRR and promotes.
Yeah. So it's always a good strategy, right? It goes both the ways. One is refinance, pull out the money, invest in the other property. And it's like then it creates the infinite return loop for the investors in that sense. Um, and as you said, right, most of the other deals that comes in the market, they are like a whole term of 5, 6, 7 years at the most. Because, there are many other, uh, I would say, calculations that the syndicator operator has to take out the profit and do the distribution accordingly.
No, that's
Yeah.
correct. So, and the shorter the hold, the higher the promote to the syndicator. So I don't really think that the interests are really fully aligned with the investor who's looking for cash flow.
Yeah.
And so I think the way we structure these things is a lot fairer to everybody because we'll hold as long as everybody else wants to hold, or even longer.
Yeah.
If you think about it, if you're investing for current cash flow, it's a really simple analysis. If you take your body weight and compound it 3% a year for the next 7 or 10 years, you've put on a lot of weight. So, that shows you where the income is
Yeah.
going. And so if your rents are compounding 3% a year for 10 years, and so you got that value, and then if you've gotten, 8 or 10% a year current, and you put those two numbers together, it's not hard to say, well, I got a great return. I almost doubled my money over 10 years. There's no reason to sell because somewhere in between there, for sure, you're going to refinance and pull out a third to half of that equity and then really increase your current cash on cash and use that money, either separately or together and buy something new.
Something new. Absolutely. So what are the different type of assets do you invest in? I know mainly focused on industrial asset, but within industrial, what specific segments?
Sure. We have tenants that do some light manufacturing, some that do assembly, some that just do distribution. All their stuff comes in containers, either through the port or on the rail, and then they break it down and repackage it and it goes into trucks, or they ship it out FedEx or UPS. We have some tenants in some of our small bay industrial, the flex assets. We have everything from senior healthcare to repair services for like Samsung appliances to engineers who need the delivery doors in the back to bring heavy equipment in. So we have a whole wide variety of tenants that are in these spaces. These are tenants that, because they need some delivery and receiving docks, can't be in a traditional office building. And that's why you call it flex. It could be anything the tenant needs it to be. Some years, tenants have more of an office finish. Some years they have more of a distribution finish. We've all seen these buildings around the neighborhood. They're single story. They may be 18 or 20 foot tall. You might have the auto body guy in there. You might have a painter in there. You might have someone who does a metal fabrication in some of these plumbing supply, where they need a place to maybe bring their trucks in and store their parts, as well as have a little bit of an office in the front to do the billing and ordering. And no one is really building this anymore. A lot of times when major national owner operators get hold of this because of the zoning, they demolish it and build traditional industrial. So it's very desirable in the right location. We've been able to keep it full even through COVID. Everybody's paid, even with the tenants. And if you think about it, the multi-tenant small bay property is really the multifamily of the industrial world.
Yeah.
You don't need credit tenants. You have credit by diversity. If you have a building that has 37 tenants in there and some move in and move out over the years, it's just like owning an apartment building.
Yeah.
But the big difference is the rents are either triple net, meaning the landlord pays, doesn't have to absorb the operating expenses, or even better yet, if they're modified gross, so you're getting a compounding of rent growth on a higher number, and the tenant is paying 100% of the increase in operating expenses. So it really shelters us from inflationary costs for payroll, for insurance, for real estate taxes.
Yeah. So that's a good thing, right? When you have a multi-tenant facilities.
Correct.
The risk is divided. If, one tenant goes out, it's not like, compared to the single tenant industrial facilities where, the risk is much higher. If the tenant leaves, then you have a vacant building, no cash flow coming in. And in this case, the other thing is you also have in the industrial space, mostly you have a triple net lease. Is it like a full triple net, or there is a part of which owner also
Yeah,
pays
sure.
for?
Some of them are just triple net. We did one deal down in the Atlanta market where it's absolute triple net, meaning that the tenant's responsible for the building itself as well.
Yeah.
Uh,
Okay.
so it depends. That was, the tenant was restructuring and it was more of a sale leaseback transaction. I said, fine, I'm okay with it. I hope they go out of business. I can make a lot more money dividing the space in half and moving the rent. But as long as they're there, you're responsible for the building, the parking lot, the roof, the whole, and it was fine. So we've done it both ways.
And seems like, as you mentioned, a sales leaseback, so that might be a single tenant facility, right?
Yes, that one happens to be a single tenant facility. We have one single tenant facility here in Wayne, New Jersey. I have Gucci in there in 420,000 feet, and I have solar on the roof. And that one's triple net. We have some others down in Georgia that are also triple net. It depends on the tenant. So some tenants can't think about the calculation for operating expenses, and they might want a gross lease or what you call a modified gross lease, where they have a fixed number, and if the expenses go up, then they pay. So it's a question of really having an answer for every tenant to keep the building full and make the same money.
Okay. So you just the lease you modify based on the tenant.
Correct.
Yeah. All right. Okay.
Yeah, because sometimes you have a government tenant in there, they just want a number. And sometimes a lot of time, because it's a large office use or finished, it might even include it probably includes real estate taxes and cleaning. It might include electric, it might not include electric, but you might, try to build in as much, because that's how governments can approve leases.
Right. And what are your main acquisition? What is the main acquisition process? Can you brief us?
Sure.
First of all, starting from finding a right location. Let's start with that. How do you determine this is a good location?
We see, in addition to all the marketed deals we see, which everybody sees from all the major brokerage community, we see a lot of deals from small, more local brokers in areas where we already own. But we're never the highest bidder. I'm the guy you call after it falls out of contract and the seller is more pliable on the purchase price. Because no matter what you say, you have to make your money on the buy. Meaning you have to buy it right. For the right basis, it'll always stay full. It's not like I have a fund and if I don't get the money out the door, I have to give it back to the investors, because then your interests aren't aligned. I'm out to make fees and get the money out, and I'm not worrying about the money. But we have no geographic restriction. We look at deals all over the country. I like to look for deals that are in markets where the tenants need to be there, that have access to major north, south, east, or west roadways, and also at higher cap rates where I can have positive leverage on acquisition when we close, so we can distribute current cash in the first year.
Do you still see properties flowing at a good cash flow rate?
Oh, we're seeing a lot of them. I made an offer on one today on an 8.5 cap. I have another one that's a 9.5 that I'm playing with. It's got some issues on the lease, but we'll get through it. So we're seeing them all around the country. And I think with interest rates being up where they were, and now with everybody's uncertainty if the new administration is going to be more an inflationary cause for the economy or not, that some people are saying, well, I've owned it for 6 years, 8 years. I'm still making money. It's time to de-risk my portfolio and sell. There's plenty of liquidity in the finance market, whether it's banks or CMBS loans or some life insurance to finance these things. So it's about going in and having that positive cash flow when I close, which is going to help me ride out any cycle.
And what are the other specifics you look at while you underwrite the deal?
I look at the condition of the property. I look at who the tenants are. It's it's a question of how long have they been there, why are they there, how much space are they occupying, do I think they're going to be there for a long time, do I think they might need to expand and maybe I can't accommodate them because none of the other tenants are going to leave and I might lose a tenant. Which is why if the property sits on an oversized piece of land and I have the potential to expand the building, that's always great as well.
Mhm.
Excess land is a plus, whether you use it for building on an addition, whether you use it for industrial outside storage or truck parking. It's a potential source of income. Uh,
Yeah.
to have the excess land. Uh, so we look at buildings that are well constructed, well made. I'm not looking at people think of some of the industrial buildings as all sheet metal. Yeah, some of them are all metal panels, like blown away in a hurricane. We like stuff that's built well, and I know will always be there, regardless of whether it's rain or snow or a lot of wind. Because even though you can insure for it, you don't want to have to go through rebuilding.
Mhm. Right. And talking about financing these deals, right? Um, what's the normal LTV ratio that you get from the bank?
Well, you could get as much as 70 or 75%, depends what
Okay.
you want. It also depends on whether you want to provide some personal guarantee or not.
Mhm.
We like to sleep at night, so the typical loan is 60 or 60% of the purchase price. And
Mhm.
when you add in the closing costs, it ends up being probably 55 to 60. So they're pretty conservative.
Okay.
This way, if you end up losing a tenant or two, you can still pay the mortgage. I tend to overcapitalize with additional funds for potential uh, capital improvements. What if we need to do something? Sometimes we also get some tenant improvement leasing commission money funded up front, and we put that in the bank because although you can calculate what the normal amounts would be, but if you have a credit tenant or a government tenant and they need a little bit more on
Mhm.
the interior finishes, I don't want to have to not distribute, and I don't want to have to say to you, hey, Mr. Investor, I need some money from you because it's actually a good, even though it's a capital call, it's a good news capital call. So we try to avoid those at all costs. And does it hurt the cash flow a little bit? Yes, but
Mhm.
it's also a cushion for anything that might happen. It's like having insurance. We all pay for it, and most of it never need it.
Mhm. And with regards to the spread between the interest rate and the cap rate, how much spread would you like to keep?
I like to keep at least 200 basis points,
Okay.
unless I've gone lower on deals that are real value add deals where I know there's a lot of expirations in the next 18 months, and
Mhm.
tenants don't have renewal options. There's a reset, and so there you might go in at a lower spread between the cap rate and the interest rate. Uh, it also depends on whether I'm investing for myself or I'm investing for third parties. If
Mhm.
it's something we think is more of a generational hold, I might go in at lower
Okay.
spreads between the interest rate, and just because I think I'm going to own it 30 years, and in 30 years I'm going to create a lot of value.
Mhm. And most of your loans are 30 year, 25 years fixed or
No,
no?
they're on the commercial stuff. They're anywhere from five
Okay, so
to
5, 10,
five,
15.
5, yeah, 5, 10,
Mhm.
15,
Mhm.
because it gives me more a chance to refinance and cash out or sell and not have somebody else assume the loan.
Okay.
We've done business with banks, we've done business with the CMBS, the Wall Street lenders, and we've done business with life insurance companies. So, every deal has a new financier, dependent upon who's in the market and what the best rate out there is.
Hmm. So it's not the normal lenders. You just go to the Wall Street uh, uh,
Well, sometimes you'll
investment
talk about
firms. Yeah.
whether it's, Providence Savings Bank, it could be Northwest Mutual Life, it could be
Mhm.
Citibank, but
Okay.
a lot of these lenders also have a capital markets platform.
Yeah.
So
Got it.
I want certainty that you're going to close. I don't want to get down halfway down the road, then you call me up and say we got to change the term. So it's about working with lenders that you have a relationship with.
Hmm. Okay. And talking about the value add-ins, right?
Sure.
Uh, one thing that you mentioned was uh, if the leases are expiring, the close to expire, you can always increase the rent. That's one of the value that you can create for these commercial. What are the other things that you'll do after you
Yeah,
acquire the property? Yeah.
I also look at properties that may not be 95% occupied. They could be 80 or 85. If I
Okay.
like the story on why the occupancy is low, Sometimes it's because the current ownership doesn't want to white box the space and make it presentable. He wants to show it to a new tenant in its current state of, I don't know what it is, which is what they say, so they can't lease it. Uh, Sometimes you might have just had a tenant move out. Sometimes the investment period, because of the investment, they have to sell. They can't hold it more than 5 or 7 years, and they don't have enough time to put a new tenant in there. Sometimes there are, family situations, whether it's a partnership split up or divorce, and people have to sell for liquidity. So I like to know the story of why people are selling, to know if it's something I should look at. But I'm not afraid of buying something that's 80% occupied. I'm not buying a vacant building, but 80% tells me that tenants are there for a reason. And with a little bit of research, you can get comfortable on the ability to lease the entire building. Also, as far as value add, sometimes we buy a building that comes with an extra few acres of land. So if somebody wants me to build for them, I build for them. If I have someone that comes and wants to park 25 tractor trailers there on a monthly basis, that's great too. So it also gives you more options.
And what is the size of this investment? Do you have like cap? Okay, for like 5 million, 10 million, the size of the property?
Sure. No, we've done deals as small as $8 million. We've done, $80 million deals. Right now, I think the sweet spot for higher cap rates, for the bigger spread between the cash flow and the financing rate, is probably somewhere in the, I don't know, $12 to $20 million range on a purchase price. So we might need anywhere from, $5 to $7 million or $8 million of equity on these deals, and we don't compete with Blackstone or Starwood or any of the other guys, because they're looking for dinosaur deals. Because if you think about it, it's the same amount of effort to buy a $20 million deal as it is to buy a $200 million deal. You still have to do the same work, the same due diligence, the same legal work. But we look at it as cash flow, because that's more important to us than long-term appreciation.
And talking about the fund structure, I know you have the family office money as well as you get the investors. What kind is it, like a 506B, C, or what kind of fund structure you have?
I would say it's sort of like a 506C. If it's all repeat people that we know already, which in some cases it is, then you can do really a B, because you know everybody. They could all self-certify, and you don't really need an elaborate PPM. And twice a year I send out an email to the investors and say, look, if you think we're doing a really good job, don't tell me, tell 3 of your friends or your relatives. And everybody, I get a couple more investors every year that way. The only question I get from my investors is, how come it takes the accountant so long to produce a K1? That's the only question I get from them. Every time they get a distribution, great job, we love you, great job. But so I can control everything except my accountant. I can't control that process.
And talking about the investors, right? Any special strategies that you implement for the investor relationship, or get or attract more investors?
Yeah, we've just recently hired someone to do some social media for us on Instagram and Facebook and LinkedIn, and I could see they're reporting the metrics that people are liking the page, that new followers are getting picked up, and hopefully when you're done editing this, I'll post this as well to our website. That will also help for both of us. But I find that there's a lot of people out there, syndicators, that have no money of their own in deals, that raise funds that are always looking for money, and I think that the investors really appreciate someone that really has skin in the game, personal money, family money. And for us, as far as investor relations, I'm available. People call me at night. People call me on weekends. I have a few doctors that work at hospitals or may have a surgery, and they let me know that morning, hey, can we talk at like 7 or 8 or 9 o'clock at night or on a weekend? And we're available. Myself and the other principals here at Peykar Capital, we're available. to our investors. That's not like you have to get stuck with a investor relations person who is really just someone to answer the phone. A lot of times they don't have answers to the questions that you might ask. Where we're intimately, we have our hands in the dough, so we can actually answer questions.
Yeah. No, absolutely. I 100% agree with you, right? Two things. First of all, you mentioned skin in the game. That's the most important thing.
Correct.
If the operator or the syndicator doesn't have the money, his own money invested, then very less likely the interest will be aligned. And the other thing, of course, you need to be readily available for any investors. Take the call at midnight if needed, and answer all the questions transparently, right? Before you
No,
sometimes even
yeah,
before
yeah.
they ask you got to present them. Okay, this is the hiccup we're facing, and this is the solution we're doing it, instead of them coming and asking you.
No, that's correct. I've had some investors that, we looked at a property upstate New York, and I have one investor who was looking at one of the universities for his daughter. And so he drove by the properties. One he was already investing in, one was a potential investor. He goes, "Do you mind if I go?" I'm like, "Sure. Do you want to get in?" And he goes, "No, I'm just going to look at the outside." So it's also making the investment available if people want to see them.
Yeah.
9 times out of 10, no one's going to look at it. But on the off chance that someone does want to look, that's great.
Yeah.
I've also learned over the years that the investor with the smallest investment is the one that needs the most babysitting. So, because they probably haven't done enough deals, and they're ultra worried about their investment, and they typically just don't understand the investment process or real estate. So, at least thankfully, most of our investors have already invested in real estate or private equity or other investments, and so I don't have investors for $50,000. Typically they're $200,000 or more. They understand that we're very happy. We cater to them, which is also why we're very accessible. Because if someone's going to write a large check, they should get to talk to whoever they want. And it's worked out very well. They're very receptive of the new deals. Some of them ask some interesting questions. Some of them say we know the area, but I appreciate when they do ask questions, because sometimes I'm too in the weeds and I may not be objective enough. You as the outsider may think of something different that I didn't think of. And so I'm always learning from my investors as well.
That's true. All right. Any specific deal that you come across, which like a difficult deal where it was going south and you fixed it? Anything as such?
We bought a deal probably in the middle of COVID. It was 180,000 square foot, 3-building property, flex down in one of the Atlanta submarkets, and we were thinking. I was looking at refinancing it 2 years ago, and so I sent it to my friends at Goldman Sachs, and they had really nothing to do. It was COVID, and so they actually called me up and they said, "Hey, you know what? We actually did a little research. We found out that your tenant is closing this location at the end of this year. It's on their website, and 11 and a half months out, I'm not thinking of calling a tenant and saying, "Hey, do you want to renew? You have a year left." About the 9-month mark, I usually start doing that. And so once we were able to confirm that, we immediately put the property on the market. And we were able to pretty much pre-lease 2/3 of it before they expired. All right, the tenants had to do some work and things like that, but it really mitigated what could have been a prolonged vacancy for a very large amount of square feet. Which is why in my leases now, where if you have a renewal option, you have to let me know 9 months in advance whether you're renewing it. If you're a very large tenant, you might have to let me know 12 months in advance. And I tell you, if you don't provide me with some notification whether you're renewing, expect to have a broker knocking on your door showing it to other tenants. And so what happens then, either they wake up and renew, or we know they're moving out. But I have a long enough period of time to have a new prospective tenant, so my downtime, if there's a vacancy, is very minimal. And on one of the properties we purchased back in June of this year, we knew one of the tenants was going out, and we knew one of the tenants wanted to expand, and we were able to get that expansion lease executed while we were under contract to purchase the property. So I just had to provide 2 months of free rent while they did their interior finishes, and it was perfect. You couldn't have asked for any better execution there.
Yeah, that's a really good idea to include the terms, right? So you have enough time to lease it to someone else who might be interested,
That's
and you have a
correct.
less vacant period. Yep. So, Erwin, loving this conversation, but would like to be mindful of your time also.
Sure.
Is there anything else that you'd like to tell to our listeners before we move on to the final round of questions?
Sure. I think that investors should focus more about current cash returns, because if there's no upside or it never appreciates, at least you know you're getting your 8 or 9 or 10% a year for 7 or 10 years and getting your money back, hopefully, rather than bet on a deal that might not have any cash flow, and you're betting it all, on, for
On
lack of a better
appreciation, maybe. Yeah.
appreciation, or how much crack the sponsor is smoking in his pipe, or type of thing. Living a dream. So that's why we focus on cash flow. I think that's really a better metric for making decisions.
Yep. Can't agree more on that, for sure. Yeah, because appreciation is a second thing, right? Sometimes if the market is really good, it might appreciate. There might be a downtime. This what happened in 2008. But if you're cash flowing, no matter how the market reacts, you'll always have some money in the pocket.
No, that's correct. Absolutely.
Yeah.
Absolutely.
All right, Irwin, let's move on to the final round of questions. Are you ready?
Sure, my pleasure.
All right. So the first one, which is the one book that you recommend which had the most impact on your life or on your business?
I thought Rich Dad, Poor Dad was kind of interesting, because it made me really think about whether my house was an asset or a liability. We all think of it as an asset, but as people have learned in some markets, that houses don't always appreciate. And what Robert Kiyosaki says, if it doesn't generate cash flow, it's a liability. Although it is a big part of a lot of individuals, wealth on paper, it's it becomes a ball and chain that you're dragging around. It's like we all talk about the money pit. Now I'm in my house 20 years, and I know the roof is starting to crack. I know I got to replace 3 zones of air conditioning. I'm like,
there's always something going on.
So there's always something going on that you have to fix. Where even if you're stuck with it, it's not like it's liquid where you can get up and move in 2 or 3 months' time if you want to relocate to another part of the country. So I thought that was kind of interesting. And he also talks about the power of compounding, where you can, if you make the cash flow on one investment, you could use that cash flow for the deposit on something else and keep growing it. So I thought that was, coming from a family with nothing. And he talks about how his father always was just like a civil servant and worked as an educator. And he just thought that was kind of a crazy way to look at it. Where he was more entrepreneurial. So that's really a good book, and I'm trying to get my kids to read it, because one thing I think is lacking at a young age is really financial literacy. They just started touching on it in some of the high schools here in New Jersey. I don't know what they do in the rest of the country, but I really think it needs to be taught at a much lower age, maybe in the elementary schools. Just basic, financial literacy and what things cost and saving money.
How money works, right?
How money works. How money works and how to make it work for you.
Yeah, exactly.
It's the one line I always like. Well, I don't know whether it was from that movie Wall Street with Michael Douglas, or what was it from Wolf of Wall Street, where he talks about it was Michael Douglas. The money never sleeps.
No, that's
the money
Michael
never
Douglas.
sleeps.
Yeah.
Michael Douglas, Wall Street. So the money never sleeps. So as long as it's working for you, you're making money.
That's right. Yep. All right. What are your main source of information to learn and grow?
I read a lot of professional articles that people put out, a lot of industry books, a lot of this trade studies. Whether it's CB, Cushman, JLL, they all talk about what's going on in the real estate markets in certain sectors. I also find a lot of useful information in the New York Times and Wall Street Journal on real estate. CoStar also has a daily newsletter they put out. And I like to go to meetups and see what other people are talking about. because I don't know everything and I can't meet everybody. But sometimes you may know somebody that I don't know that has a different view. If you think about it, if everyone looks at something from another perspective and we all get to share ideas, we all have more of a well-rounded view on a subject.
Talking about the meetups, were any specific meetups you like to highlight in New Jersey?
No, you know what? I saw them in other states, and sometimes when I'm traveling, even on vacation, I might drop in on one. I'm looking for some in New Jersey. I get them a lot of time, from the alumni. Like I went to New York University, so like NYU has one a couple times a year, and I get dragged to some other meetup groups with friends of mine who belong to other associations. Like there's the Asian Real Estate Investor Group. There's all sorts of these other investor groups, and sometimes it's about just striking up a stranger. Conversation with a stranger that's talking about real estate, where you can get your way into a conversation just to see what they know and exchange ideas.
All right. Okay. What is the best business or investment advice you'd like to give to our listeners?
Invest with your head not above it. Don't get your eyes open really wide, thinking about a future return that may never happen. Again, it all comes back to cash flow. And, investing for a purpose. What are you trying to accomplish? That really should determine, what you're investing in and how long you want the investment to be. And then you also have to really think about, can you afford to lose the money or even half of it or part of it? Because no one likes to think that's going to happen, but it's a possibility even in the stock market.
Yeah. You never know. Yeah. All right. Final question, Irwin. How can Decoding Cashflow listeners get in touch with you?
Sure. You can put my name in the search bar at Google, Irwin Boris, IRWINBORIS, or you can email me at irwin.boris@peykarcapital.com, or else go to our website, PEYKAR.capital, and there'll be a contact us page, and I'll get an email, whatever you want to do. If you're thinking of investing in industrial, you've never invested in Flex before, it's something you want to explore, by all means, please feel free to call.
All right. We'll also put your contact details when we, post this podcast. So our listeners can also check out the details and get in touch with you.
No, I appreciate that. This was a lot of fun. I'm glad I was able to, spread what I know, my little bit of knowledge, my 3 cents worth to your viewers.
It's always good to have, experienced real estate investors like you on the show. It's every little knowledge, every additional knowledge counts. It's all, as you said, it's compounding knowledge instead of compounding interest.
That's correct.
Yeah. All right, Irwin, it was a pleasure talking to you, and we'll stay in touch.
Thank you so much. I look forward to it.
Thanks for listening to Decoding Cashflow, brought to you by Aster Capital. If you found value in this episode, then please share it with someone who you think could benefit from it. And make sure to act on what you've learned. If you want Ted Patel to personally help you reach your goals, then feel free to set up a one-on-one call with him. Also, visit us at astercapital.com for more free resources. Content of this podcast is for informational purposes only. As always, please consult your own advisor before making any investment decisions or setting a course of action. Thanks again for joining us on this episode of Decoding Cashflow, and we'll catch you in the next episode.